This is Company Breakdowns from Turpentine, a deep dive on a compelling tech company's strengths, TAM, business model, and potential for market domination. I'm your host, Erik Torenberg, and on this season, I'll be joined by the smartest people in tech to record deep dives on companies like Reddit, Databricks, and more. Today's episode is with Drew Cohen of Speedwell Research and the Synopsis Podcast. We'll be discussing Copart.
Drew, welcome to Company Breakdowns.
Thank you for having me.
So excited to get into Copart, but first, why don't you give a brief intro to Speedwell and how you guys do these reports? Because I hope we have you on for other episodes in the future, and you guys also have a great podcast. So first, I want to introduce you and Speedwell.
Oh, absolutely. So my name is Drew Cohen, and I run Speedwell Research, and we focus on in-depth research of what we'll consider to be quality companies. And so what we really want to focus on is great companies with longevity, moats, high ROIC, all of those sort of cliches that you like to hear about on companies you like. Our reports will range anywhere from 80 to 160 pages at the most. And we just really focus on all publicly available information, scuttlebutt, and really are trying to get to the ethos of each company, as well as everything involved in really understanding what makes them provide a unique value prop that is hard for others to mimic. And so that is what our reports are about. Speedwell Research produces about 8 reports a year, so I'm pretty slow to put them out, but they are pretty thorough. And as you mentioned, we also have a podcast which you could find for free. It's called The Synopsis. And on there, we go into real in-depth into each of the companies that we cover in our report. Those can be pretty long. Maybe some will consider arduous podcasts. But if you are really interested in any of the companies we talk about, we have Floor & Decor, Meta, Copart, Constellation Software, Coupang, among some others. Those are just really long podcasts going into really the nitty-gritty of the company, the financials, the history, and everything involved.
That's a great overview. Why don't you go deeper into how you put these reports together? What's your process?
Sure. So it varies a little bit company to company. All of the companies, though, all the companies have like annual reports. So we'll read all those. We'll read all the public filings, earnings transcripts, if they have those, company presentations. And then from there, it's about really kind of understanding the story of the company. And that might involve going really deep into Google, finding really old articles, old interviews, anything involving the company and its early history, understanding the problem they're trying to solve. And very often, it's the problem the company is trying to solve doesn't change decades later. Amazon with Jeff Bezos is originally trying to solve for the best e-commerce delivery service. He focuses on the quickest delivery, the most selection, and the lowest prices. And we could sit here 2 decades later and say the retail operation is essentially the same. And so when you really understand these problems that an entrepreneur is trying to solve, and we could even, we're going to talk about Copart today. It's a similar thing for Willis Johnson and what he's trying to solve for the insurance companies. It's the same thing decades later. And so you understand that, and it gets imbued into the DNA of the company. And over time, you want to understand what that is, and that's how the company's built up. And so that's kind of like the beginning of the research process. Then you look at competitors, you go through their filings, their transcripts, and a lot of it is just trying to really put together your business analysis and see what actually makes sense, whether or not the business they're trying to operate or get into, it really makes sense that there's a moat there, and whether or not there's rationale. And there's a lot of times where you could point to a company or read an annual report and you're like, this just doesn't make sense. I don't really see anything unique here. There's nothing they could really protect. And some of it is just something you build up over time, the more the companies you look at. And so our reports are written much more like narrative than any sort of sell side report. I used to work at Goldman Sachs and in the investment research team. And when I worked there, they were very focused on a lot of data, a lot of charts, a lot of graphs. An initiation report might be 100 charts with different permeations of the same data showed in slightly different colors, although they did restrict us to only blues. And that compares to what we do, where we're really trying to understand the business, the core value prop. And we're not so concerned about data, which will change quarter to quarter, but rather, what doesn't change in a business.
That's really interesting. Let's segue just while we're on the topic, and what usually doesn't change in a business? What are some examples of that?
Yeah, I mean, so there's a lot of businesses where fundamentally what they're trying to do, at least with a great business, it doesn't change over time. And so Floor and Decor, they're still trying to solve for having the most flooring, the most in-stock flooring at the lowest prices. Copart, which we'll get into, is still trying to solve for getting the insurance companies the best services with the highest price for each car sold. I mentioned Amazon. Apple is still very much focused on having the best consumer experience and focused around providing a device that allows personal compute. And there's all sorts of different companies that will focus on a certain thing and just try to relentlessly improve on that single vector. In contrast, Not Great Company is kind of looking for new markets to solve, new business problems to solve, because they have a business problem. They're not trying to solve something from a consumer perspective or a business friction point perspective. Rather, instead, what they're trying to do is they're trying to figure out how can we make more money, and then back solving into a potential problem. But very often those problems don't exist the way that they hope they do. And so I like to also think about this in terms of the consumer hierarchy of preferences, which is this sort of framework that we coined, very much a ripoff of Maslow's hierarchy of needs. And the idea there being that consumers have different preferences, and the more preferences you could fill, the more likely you are to elicit a sale from that consumer. And once you elicit a sale from the consumer, if you continue to fulfill even more preferences beyond that, then what you're doing is you're building consumer surplus. And that's basically latent pricing power. And, one of the hallmark examples of this is, of course, Costco. And so if you're looking at Costco, everyone knows that they could charge a little bit more, but rather than charge more, they continue to focus on providing even lower prices, which in turn shows up in more volume, which you could also think about showing up as lower customer churn, because very few people ever leave Costco once they become regular customers. And so what you're basically seeing is that consumer surplus gets swapped out for customer longevity. And so instead of trying to take price now, you're saving it in reserve, and it compounds over time. And that was a little bit of a rant, but that's roughly how you could kind of see when a company is really focused on something, they'll continue to work on that over time. They'll build consumer surplus over time. And if they really are solving a consumer need, then you'll see that they are able to do that for a very long time, decades.
Right. That's a good overview. And so Copart, the company, what made you pick this one that would be a good one to not only do a research report on, but of all the reports you've done, focus on as an episode here?
Yeah, it's just a very interesting company in terms of its competitive position, which we'll get into. It's very formidable. It has like multiple layers of competition. Some people talk about a company having, some sort of marketplace, network effects, physical assets, integrations, being, an exclusive provider, and Copart basically has all of these. And so in terms of a business, it's very impressive. Willis Johnson, the founder of Copart, he himself is also very impressive. He's basically started working at scrap yards when he was little. His father worked all sorts of different jobs, and one of the jobs he ended up getting was liquidating a bunch of scrap metal and vehicles. And from there, he decided that he liked the scrap yard business, and he started moving up and up the value chain from owning a scrap yard to selling individual parts to then moving into auctions, and then later moving into what Copart is today. And so it's just a very interesting story of an entrepreneur who found kind of this niche area. He himself has become a billionaire off of these junk yards, as well as his son-in-law has too as well. And so it's just a very interesting business.
Yeah. Let's get into the business. For people who are unfamiliar, why don't you give a basic overview, and then we'll get into specifics.
Yeah, so kind of the one-liner on what Copart is it's a salvage vehicle marketplace. And so what that means is effectively Copart is the one who helps the insurance company when a vehicle is at the end of its life. And so let's say you're in an accident, your car gets totaled. Where does the car go? What happens to the car? That is where Copart steps in. They're the one who works with the insurance company, arranges the pickup of the car, the storage of the car. They'll clean it up a bit, put photos online, and then they'll sell it globally, giving the insurance company their fees, giving the insurance company their money back for the car. And so that is basically what Copart does. And so Willis Johnson likes to describe them as being the sewage system, basically. And so you have these two big industries. You have the automotive industry and you have the insurance industry. And you have Copart, which sits in between. And they're the ones who facilitate, in some cases, a second life for the car, but also the dismantlement of the car when the car can no longer be repaired. And we'll get into all of that.
And can you give a bit more of the founding history, or
Yeah.
what existed before this, or why was it innovative? Yeah, let's get into it.
Yeah, let's get into it. So if you go way back, and we're talking late 70s, early 80s, this industry didn't exist as it was. Basically, a car would get salvaged. There'd be a local tow operator would pick up the vehicle, bring it to its local tow yard. Maybe there's a local auction house that collects a bunch of these cars, and we'll have an auction where maybe people are willing to drive up to 50 miles to sell it. And you're talking about very little word of mouth, very unclear price opacity. And on top of that, it's just not a lot of volume coming through it. And so that is kind of where we're at initially. It's these local operations. Copart itself, before it was Copart, was one of these local operations. It was called Bob's Tow Services, or BTS Auctions. Willis Johnson purchased this in the early 80s, and basically was able to quickly find out that the more of these auction houses that you put together, the better business it becomes. And it becomes a better business because you're able to draw in more buyers, you're able to get more supply, and you're able to get better pricing for the vehicles, which in turn helps you draw in more supply. And so these insurance companies moved up from basically working with these individual to regional to now it's a national business. And so it's ultimately an insurance company like a Geico and Allstate. They're now contracting out to Copart and the other big competitors, IAA, for a large portion or all of their supply within a region. And so these are now service providers who are taking care of all of the salvage vehicles in the area. And so if you're kind of going through the process of that, how that happened, Willis Johnson was rolling up a lot of these different operators. IAA was as well simultaneously, and they were both kind of having a battle at just trying to get as much land as possible, as many operators as possible. They both had very different styles, whereas Copart would try to acquire a yard, get everyone moved onto their system, and had a very regimented way of doing things. IAA was much more just focused on the financials, much more focused on just very aggressively acquiring these yards, and more or less left them alone once they acquired them. They were more Wall Street savvy. They IPO'd years before Copart in 91, I believe was their IPO. And at that point, Willis Johnson, founder of Copart, kind of looked at the IAA IPO and said, they're not doing anything we can't do. Let's also IPO. And so they first raised private money, expanded even more, and then they also eventually IPO'd. And so these two providers were going at it for a long time. IAA was better funded and they were larger. Copart, though, is much better run, and it's taken them decades, but they eventually surpassed IAA. And so the reason why an insurance company would go with one over the other is not just who can get them the highest price, but it's also who can provide them the best service. And we could get into everything entailed in that, but in short, Copart provides a better service. A lot of that has to do with what happens during catastrophe events. We could touch on that. But as of now, Copart does have a dominant market share.
I want to get into how they provide better service, but first, how do they do it despite being much more underfunded or much less funded? And maybe say more about how their sort of funding path to begin with. How are they acquired?
When I made that comment, I was talking more in like the 90s. IAA, had this IPO, and they had much more Wall Street and institutional support initially. And so, in terms of how they built it up, it was just a lot slower, and they would contract out for these different yards. They would acquire these yards. They would kind of attract different entrepreneurs. And so IAA, when they went to acquire a yard, they're showing up in suits and limos, and that impressed some people, turned off others. When you're talking about these, local yards out in, the middle of nowhere, whereas Copart was much more focused on kind of building a network out first rather than going for these like marquee locations. And the funding, they eventually raised private funding. We have the exact dates and all the funding rounds in the report, but they did have several private investors before they ultimately IPO'd. And then it was around, I believe, 2001, right after 9/11. He kind of had this insight that in the face of all, fears of flying, there'd be a lot more people driving. A lot more people driving means a lot more accidents. And so they raised more funding at that point too. And so the funding hasn't really been an issue. They've had plenty of cash flow to self-fund, but that just was kind of an aspect of that. It's definitely earlier on. And also part of the reason why IAA is like more of this patchwork of different yards versus Copart has always kind of been more unified. And even in the mid 90s, they had this effort to move everyone onto a unified enterprise resource planning system. And as a result of that, they actually stopped acquisitions for a while to make sure all the yards were on the same KPIs and operating at the same level of efficiency. And so Copart's also been much more tech savvy in that regard, that we could get into when they moved online, which was in the early 2000s, like 2001. So they were one of the first internet companies too, which is also quite interesting, but we could get into that.
Why don't we start at the high level and then go specific? What do you think are the best sort of broadly generalizable business lessons from Copart's success that students of companies should internalize as they evaluate other companies or think about building companies?
Yeah, there's a lot. I actually wrote a piece on lessons from Copart. You can find at speedwellmemos.com. But I think some of the big ones, one is you want to control your growth. Unfettered growth is never a virtue. And so while IAA was just snapping up all of the yards that they could, Copart was much more focused on being methodological and the yards they actually did end up acquiring and really integrating them into their system, bringing them up to speed, and then making sure the service levels were good, because none of this mattered if the service levels weren't good. And so I think that's one lesson. They were really savvy with capital allocation. They never bought back stock for a very long time until when they did decide to do it around 2008, the financial crisis. They basically saw how resilient their business was. Not only did they aggressively buy back about 25% of their stock in 2 years, they issued debt in order to do it. And the prices they bought back the stock now, it's like 5% of where the market cap is today. So those were very accretive buybacks. And so, controlling your growth, proper capital allocation. Another big lesson is to know your job. Everyone talks about the Clay Christensen framework. What job are you hiring a product for? And it's kind of interesting because Willis Johnson never went to college. And so he doesn't seem like the kind of person who would study Clay Christensen, but he's still talking about the job Copart does. And he has his autobiography you could read called Junk to Gold. And in it, he lays out very early what Copart's job is, which is in order to get the most money for the insurance companies. And when you have that level of clarity, it's very easy to organize your operations around it. And so you could kind of see some people would wonder whether or not it's really about accommodating buyers, making sure the buyers have a good experience, or worrying about something else. No, he really lays it to rest. He says, no, it's only about the insurance companies. It's only about making sure they make the most money. And so those are a few big takeaways I can think of off the top of my head. But there's more. And you could go to Speedwell Memos, and we wrote a piece on that.
Hey, everybody. Erik here with a word from our sponsors. The tech world turns to the Brave browser for its unbeatable privacy protections. But did you know that Brave also has a private ad platform? Brave Ads offers first-party targeting, and it's been cookieless since day one, so you can relax while third-party tracking cookies disappear from the web. Today, millions of people turn to ad blockers to avoid being tracked and pestered online. But Brave's new ad model aligns incentives for users and advertisers. Users earn rewards for viewing ads, which they can save, spend, or pass along to their favorite creators. And advertisers score points for respecting user privacy, generating ROI without invasive tracking. So whether it's high-impact announcements on the new tab page or keyword-targeted ads in Brave Search offers diverse, private, future-proof ad formats for all your business goals. Join the future of advertising at brave.com/ads. Mention Turpentine to get 25% off your first campaign.
Follow up on the buybacks part. What is the right framework for companies to think about sort of the pros and cons or timing or sequencing as it relates to that?
Yeah, so a lot of times when you think about buying back your stock, obviously it's valuation dependent, but the thing that's usually missed is you also want it to be return on invested capital accretive. And so you're looking at basically your opportunity cost. And so I think the general framework that most businesses will use is they'll say, okay, we can either allocate money to internal investments, we could do an acquisition, we can buy back stock, we could do a dividend, we could repurchase debt. And so if you're ignoring issuing a dividend or repurchasing debt, and those should probably be kind of more last of line decisions. First, you want to see whether or not you can invest accretively. So the first thing you're going to want to see is whether or not you can invest accretively. If you are able to put money to work at a high ROIC, that is usually what you're going to want to do. There are situations where maybe your stock is trading so cheaply that that seems like a relatively more attractive place to put it. But you could kind of just think of when you're buying back stock, you're basically investing more money in the assets you already have. And so if you're thinking of investing and getting a 20% return on invested capital, Copart actually's return on invested capital is closer to 25% and 30% recently. And so if you're comparing that to buying stock that maybe has a 2% earnings yield, the only way that makes sense is if you're thinking of that 2% earnings yield and the company being able to retain it and continuing to invest it at a higher rate of capital. But there's a bit of a paradox there, because if they were able to invest it at a higher rate of capital, then they probably would have been doing the internal investments in the first place and not the stock buyback. That's kind of a long-winded way of saying that usually it's a secondary consideration, and definitely in Copart's case it is as well, to do a stock repurchase only after you've extinguished all of your potential for internal investments. And for their sake, acquisitions, since they're small, they're buying lots, they're buying land, are essentially considered internal acquisitions. And so for Copart, it'll be internal acquisitions, internal investment, acquisitions, and then stock buyback. And they've never, outside of a small amount of debt, really had much debt. And today they don't have really any outside of operating leases.
There's a few things I want to dig into. So first, maybe we could talk about one of your lessons you have here is the importance of aligning incentives, and you talk about how they change their business model to do so. Can you get into that?
Yeah. So that kind of goes back to the job to be done, but it also goes back to something Willis Johnson created called the Performance Incentive Program. And so what he realized when he started getting these cars for insurers and selling them, the way it originally worked was that he would become the merchant of record and in some cases actually pay the insurance company for the car. And so they'd come up with the price, he would pay the insurance company, and then he'd go and auction it. And he would try to clean up the car, make it look nicer, and then get even more money for the car when he did that. And he kind of realized that his incentives were not in line with the insurance company, because it was kind of like they were a partner, but at the same time, he wanted to give them the lowest price possible in order for him to make more money. And when he did clean up these cars, the thing he realized is that if you, and by cleanup, I mean, this is still a damaged vehicle, but you pull out the debris, maybe you give it a car wash so it looks shiny, and you get a higher price for it. And so that was happening. And he thought that it'd be best for him to share these profits with the insurance company. And so instead of continuing to try to just buy these cars for cheap, he said, I'm going to come to you with a program. You're going to contract me for all of the supply in a certain region. You're going to give me all of your vehicles, and you're going to pay me a set rate. It's going to be, I believe it was 10% originally for a clean car, 20% for a fired out damaged car. What this did for the insurance company was they no longer were losing money on certain cars from the storage and the towing and the sale of a vehicle, because there was a lot of fixed fees they were paying. And so instead, they're just sharing in a percent of the profit. And so there were some units where they were no longer losing money on a car. And so if a car was fired out and damaged and would only sell for $300, maybe the insurance company was paying $500 in storage and towing and all that. So they're losing money on that car. On other vehicles, maybe it was a nicer car that was selling for $3,000 and they were still paying $500 for it. And so they're making better money on that car. But what he said was, forget all that. We're just going to give you, you're just going to charge us a percent of whatever it ultimately sells at auction for. And so as a result of this, they no longer had this lumpiness and some cars being loss making and some cars selling for more. But they also now had an incentive to make the cars look nicer and get the highest price too. And so that's kind of where they shook out with the percentage of the PIP program. And so they rolled that out in the early 80s, 90s, and insurance companies started adapting it once they realized that they were getting much more money from Copart taking on the fees and the cost of cleaning up the cars, and everyone was basically making more money as a result.
The one thing I want to transition to related to that is you mentioned that the Copart expanded carefully and deliberately. Why don't you unpack that a bit?
Yeah, I mean, I think we touched on it a little bit when we talked about the acquisitions, finding the right locations, and then also just making sure once you acquire someone, getting them onto the Copart system, the KPIs. Willis Johnson actually was one of the first to buy a computer system in the 80s for his salvage yard. And this was only when he had a couple of them. And that was because he realized the importance of knowing all the inventory available and making sure there was no mistakes. And so a lot of just growth has to do with just keeping your service levels high. And so, yeah, I feel like we touched on that one.
And when you say they were excellent at capital allocation, that's both on these acquisitions that they made at good prices, but also just keeping costs low, or what was their particular?
Yeah, I would say it's that. It was the stock buybacks. And then you could also say it's the things that they don't do. And so if you go back to the early 2000s, they were starting to get into all these other businesses. They acquired something called Motor Auction Group, which was selling clean title cars, not salvage vehicle cars. And so there was all of these different businesses. That was one. Another one was dealer whole car, where you're selling cars dealer to dealer. And they were looking at these businesses, and they ultimately came to the conclusion that these are lower ROIC businesses. They don't have the same sort of competitive advantages that Copart has in their core business. And so as a result, they sold them and stopped investing in those businesses. And so a lot of capital allocation is making good decisions, but also just not making bad decisions.
Yeah. Let's go back to when you were talking about their competition with IAA, and let further flesh out the differences, the cultural differences, the structural differences that led them to be able to compete.
Yeah, so IAA kind of always was a little bit more Wall Street focused. As I mentioned, they were really like quickly trying to roll up this industry as much as possible, whereas Copart was a little bit slower in doing that, although they both were pretty aggressive. IAA was the biggest supplier first and had all of these insurer connections before Copart did. And so Copart basically had to earn more supply from the insurance companies. And so the way they did that was providing a better service. And so what happens in a catastrophe event is that your service levels and how good you are at organizing the logistics operation and everything involved in that really gets exposed. And so Hurricane Katrina was really a turning point for Copart, where now all of a sudden you're dealing with like 10x the normal capacity of cars. And so you need to have immense amount of surge capacity to deal with this. And so what Copart did at that time was they bought or leased all this extra land in the area. They paid at their own expense for all these sub-hauling trucks to come in to deal with all these vehicles and to move them out and to get them sold quickly. And in contrast, IAA kind of floundered that. And so this is important to the insurance company, because a lot of times if you're not dealing with getting a salvage vehicle moved quickly and getting the customer their money back quickly, it could be a churn event. And so customers, if they're sitting with a salvage vehicle in their driveway for 4 weeks, they're going to be calling up this insurance company pretty pissed off, and they're going to also want it gone so they could get their money back. And that was happening more with IAA cars, where Geico was one of the suppliers that actually, one of the insurance companies that ended up switching to Copart. But this was happening more with IAA than Copart. And so because they had these higher service levels, insurance companies wanted to make sure they had Copart as one of their service providers in the event that there was a catastrophe. And so since then, Copart doubled and tripled down on this. They buy all sorts of extra land nearby potential catastrophe areas, and they leave it empty, and it's only there in the event that there is something like this that happens. They even bought their own trucks just again for these sort of events. And so really focusing a lot on the service level is one of the ways Copart differentiated itself early on versus IAA. IAA kind of tried to do this later on, but they've been switching hands and ownership a lot. And that's definitely weighed on their ability to execute a coherent strategy. And so at one point they were owned by, they were taken public, then they were owned by PE, then they were taken public, then they were owned by something called KAR, K-A-R, which was a mini conglomerate of these loosely related car companies. They had financing and whole car auctions, and then IAA, and there's never really any synergies there. there. And so they ended up spinning it off. It was public a couple years. Now, another auction house, Ritchie Bros, ended up buying them. Ritchie Bros specializes in what's called like yellow metal, which is construction equipment. Basically the same thing for construction equipment that IAA does. But again, they're saying there's synergies. There's not really that many synergies because the yards have different licensing. It's kind of too hard to intertwine and mesh a passenger vehicle with construction equipment vehicle. It's different markets, et cetera. And so because of all this kind of ownership changes, it's definitely weighed on their ability to really provide that high service level. And so that's kind of where they are today. They both still have somewhat similar market share. Copart is ahead of them. It's hard to estimate it out. I believe we estimated Copart's closer to like 50%. Whereas IAA is like 35 or 40%, and there still are some regional players. But that is kind of where they are today. And everyone does, or a lot of the insurance companies prefer Copart, except the problem is they don't want to depend on just one supplier. And so they do cut IAA a little bit more slack.
And you talk about how they've done a great job of expanding beyond North America and also beyond salvage, right? Or when you talk about that?
Yeah. So they're 80% of their business is dealing with these insurance companies. And then they have this 20% of their other business, which is dealing with cash for cars. That's directly buying cars from consumers. Maybe you've heard the commercials. Then you also have rental fleets. You have bank repossessions and similar kind of things like that. And so real quick, I don't know if we made the distinction clear, the difference between a whole car and a salvage vehicle is that once a car gets in an accident, basically an appraiser comes and they decide whether or not it's worth repairing that vehicle. And the way that they decide whether or not it's worth repairing that vehicle is if the cost to repair is greater than what the value of the car was before the accident, less the proceeds they would receive in auction. And so basically, if they're repairing the car and it's going to still be worth less than it was before, they decide to not repair the car. And so that's salvaged. And then once it becomes salvaged, the title actually changes and it becomes a not clean title, a salvage title. And so that is all the insurance business. They're all basically salvage vehicles. And so usually only a licensed salvage vehicle mechanic or someone with a license, it varies by state, is able to buy that car. Then the other business they have are these clean title cars, which despite, calling them clean, they could still be very damaged and old, but they're workable. And as far as the DMV is concerned, they're allowed to be on the street. And so that is the other 20% of supply that I mentioned. What's been happening is that they've been slowly creeping up into more clean cars and more higher quality cars. There's something called Blue Copart, which is their Copart direct business where they're buying cars from consumers. These are workable cars that even if they are very old and, used up, they're still higher quality than their typical salvage vehicle. And so they're getting more of that supply in. When that supply comes in, basically the average selling price of the cars start to increase. Because the average selling price of the cars are increasing and they're taking a take rate on the price, their revenues are increasing. And that is kind of big picture, something that's been happening for a while within Copart. And that is kind of more the domestic opportunity there. And then we could switch to talking about international. Their first international operation was in UK. That was in 2007. And kind of the same thing that was happening in the US, where back in the 80s, these insurance companies were just giving Copart a fixed fee, and they were kind of assuming that they were giving them a fixed fee, and they were just assuming that the car would sell for a certain price, and they were not necessarily getting the most money for their price because they weren't willing to pay Copart to clean the cars on their behalf. Okay, that was the UK in 2007. And so over time, they moved them to the performance incentive program. ASPs start rising because they're cleaning the cars and they're getting a higher price for them. The network effects and auction liquidity is taking over, pushing up more pricing. And so now they have dominant market share in the UK. There are several other markets they've entered, Germany, Bahrain, a couple others in the Middle East, Brazil, a few in Latin America. They entered India and exited India because that wasn't working. They're in Finland and a couple other EU markets as well. And so it's been going, and that's definitely earlier innings. Germany is probably one of the bigger opportunities, and that one started quite a while ago now. But a lot of these markets have different market structure than what we see in the US. And so in Germany, for example, in contrast to the US, where when you total a car, the insurance company gives you cash, the insurance companies in Germany let you keep your car, but they just give you the value of the damage that was estimated to occur. And so if you're in Germany and your car gets totaled, you sit with a totaled car. It's your responsibility to sell that car and get money for it. And the insurance company will say, oh, it was $10,000 of damage. We'll give you 10 grand. And so this is a bad experience for the consumer because they have no idea where to sell their salvage car. They don't want it just sitting around in their driveway, pissing off their neighbors. But that is the market structure in Germany. And so over time, Copart kind of had to take multiple steps to move the market into the same sort of model we see in the US, where it's the insurance companies picking up the car, paying the consumer directly, and taking the responsibility for it. And in order to do that, they first had to buy one of these marketplaces that sold these salvage cars on consumers' behalf. And then once they got the pricing data and they started buying cars on their own, basically acting as what ultimately they wanted the insurance company to act as, they built up data and pricing data that showed if you take over the car and then give it to us, we'll clean it up, we'll put it on our global marketplace, we'll get you more money. And this took a while for insurance companies to buy in. They're doing various tests now. They've gone, as far as we know, they've gone successful so far. And so that'll be a long ramp up too. And so there's more units that could come on there. Just kind of to level set though, in terms of TAM, there's 300 million vehicles in North America. About 10 to 15% of those get in some sort of accident every year. So that's like 30 to 45 million. And of those 30 to 45 million, 5 million of those, roughly speaking, end up being salvage vehicles. And so that is Copart's key market, and that's in North America. And then you could do a similar sort of calculation for all of these other international markets too.
And say flesh that out a bit more in terms of how big of a business can this get?
Yeah, so it's a byproduct of two things. One, it's going to be what their market share is amongst these salvage vehicles. But two, it's also going to be to the extent that they move beyond salvage vehicle into these clean title but pretty used damaged vehicles. And so there's a lot of cars out there. And the question is, how many of them are they going to be able to sell? And so the insurance business is 80% of their business, as I mentioned. That's their core business. They're expanding out into doing more of these clean title vehicles. Where that can end up is kind of anyone's question. If you think about like what, some of these used vehicle marketplaces are doing, in theory, there's no reason why Copart couldn't do that. They have a lot of buyers. They have clearly the infrastructure set up between transportation and land to be able to move up market. And I mentioned that in the past, they tiptoed into these markets and pulled out because they felt like they were too competitive. However, if it kind of naturally continues to happen as it has been happening, then perhaps they do end up having more of these higher quality cars. And so as a result of that, it's hard to say exactly where the TAM can ultimately end up. We do this analysis where we try to estimate out vehicles, accident rates, salvage rates, and we get somewhere where there's like a potential salvage vehicle TAM of the markets they're in of like 10 to maybe 20 million, of which they're serving like 3-ish million today. And so that looks large, but when you're really getting into it, it's going to be a lot harder for them to achieve anywhere near total dominance of all of that. Could happen over a very long period of time, but it just won't be immediate. And that's on just the volume side of the business. The other side of revenue, of course, is ASPs, as I mentioned. And so something that's been happening is that the more cars that get totaled, and the more cars that get totaled that are of higher quality, the more ASPs rise. And so what's generally been happening in the car industry is that cars are getting a lot more sensors. They're getting a lot more technically sophisticated. They have wires, miles of wires in each car. And so when you get in even a fender bender, you have to total the car. But otherwise, it's a pretty nice car, a pretty expensive car. And so this now may be that you're totaling a car that typically before all this tech went to it and sensors went into it, of course you would have repaired it. And so the byproduct of that means that now more cars are getting totaled and the average value of these cars is going up over time too. And so if you're looking at the total salvage rate in the early 80s, you're looking at somewhere around 4%, whereas now it's closer to 20%. On a earnings call, Jay Adair, who is the son-in-law of Willis Johnson and was the CEO for a couple decades, he thought at one point it could get to 35 to 40% total loss rates. And so that would definitely be beneficial to Copart, provided that these ASPs are holding flat or increasing as well.
Yeah, that's a helpful overview. When you further flesh out the moat and the depth of the moat and why it's so particularly impressive to you?
Yeah, so every minute, 10 cars are totaled. And so if you want to get into this business, let's say, what are you going to do with these 10 salvage vehicles? Where are you going to put them? So your first thought is probably going to be, okay, I'm going to buy a big centralized lot and we'll just put all the cars there. Except that doesn't work because you need the lots to be close to where the accident happens, because otherwise you're paying a lot in frivolous shipping costs and it won't be profitable to ship a car, all the way to the middle of nowhere. And so you need to have all these lots everywhere near where the accident happens in order to be efficient. Okay, so now you have to have lots everywhere. The problem though with that is that most of the time the land doesn't exist anymore. Copart and IAA have been buying land since the early 80s, or at least in IAA's case, they've been leasing a lot. But you've been acquiring land since the early 80s. A lot of the land that is near suburban areas now will never get the licensing in order to be a salvage vehicle lot. And you can imagine that no small business or residential owner is going to want to live anywhere near essentially a junkyard. And so it's very hard to get the land. It's very hard to get the land in the right place. And then it's also very hard to get the right licensing for the land. Of course, though, that is just like the beginning, because once you get the land, then you need to basically build an entire logistics apparatus in order to move the cars to the right places. And so that involves having a network of subhaulers, third parties that you could contract out, people you trust, people you know, and knowing exactly which lot to bring which car to. Of course, though, you can't do that unless you actually have the vehicle supply. How do you get the vehicle supply, though, when it is basically 10 insurance companies that own 75+% of all of the salvage vehicle volume, and there's already exclusive contracts with Copart and IA for most, if not all, of this volume. And so Copart is directly integrated in with these insurers. And so when there is an accident, very often, not only is it Copart that is automatically basically being sent to these different locations, knowing where to move the car to. On top of that, they also have something called the price quote tool, which is telling the insurance company the value of the car. That is a critical input that they need to know whether or not they should salvage the vehicle or repair it. They can't know that without Copart's level of data, though, that they have. And so that's just another layer of integration they have. And so on top of all that, let's say you are able to do that, you're able to get some vehicle supply, then you're going to also need to build up the entire marketplace on top of that. And so you need a lot of buyers, and buyers not just coming from a regional or national level, but globally. And so if you were able to get global buyers, then it's proven that the average price you'll get for your car increases. And you can't get global buyers, though, unless you're operating in multiple markets all across the place. And so you see that there's all these multiple layers. Just to even begin to get into this business, you have to have the land, you have to have the logistics apparatus, you have to have the marketplace, you have to have the integrations with the insurance company, you have to have the data to have the price quote tool. And then on top of all this, why would anyone switch when Copart has the best reputation? They have a reputation that wasn't built up, overnight. It was built up over decades, years of catastrophe events where they bore the cost of dealing with surge volume. Now it's 10 times what it usually is. Whereas, even a competitor, IA, who's been in this business for decades, floundered to do the same. And so you see that it's very hard to compete and to embed yourself anyway into this value chain. There really would be no reason for an insurance company to want to move their volumes out. And if they're not moving their volumes out, there's no way they could ever get the marketplace. And let alone, they can't even get started because they can't get the land. They can't get the proper licensing. And so it's very hard to imagine anyone trying to compete against Copart, other than IAA, who currently is, of course, a duopolistic structure there.
Yeah, it is interesting to look at a business that, like they did with IA, that's having a bunch of success and saying, "Hey, we could do this significantly better," because that's not always the case.
Yeah.
One thing I also want to get to is, what about the sort of autonomy or self-driving cars, or just how sort of the industry at large is shifting, or technology is shifting, that could influence the business?
Yeah. So that I like the existential risk for Copart is that, every car is fully autonomous and never gets in an accident. And if there's 0 accidents, then of course there's no salvage vehicles for them to sell. And so that is kind of the existential risk and what people will point to when they say, they're worried about it. Keep in mind though, like I said, there's 300 million cars in the US, right? On an average year, let's say you're selling 15 million cars a year. So that implies the car stock in the US won't turn over for 20 years. Okay. So on top of that though, when is autonomous actually going to be ready, and what % of vehicles sold are going to actually have fully autonomous capabilities? And so as of now, it is quite expensive. If you're getting fully self-driving in your Tesla, it's like 15,000, something like that, or you're paying a higher monthly fee. And so that is going to price a lot of people out for a long time of even considering getting a fully autonomous vehicle. And so if it takes years to get the proper licensing where fully autonomous fully works and it's fully allowed, and if it also takes years to get the price down for enough material portion of cars sold to even have that capability, then it's going to, on top of that, take a long time for just the existing stock of cars to turn over. And so if you're putting all those elements together, it could be, at minimum 20 years, maybe 30 or 40 years. No one really knows how it'll play out if there's only some autonomous vehicles and other vehicles that aren't. Does it actually mean accidents go down? Or does it just mean that maybe accidents go down, but when there is an accident, it's so expensive to repair these cars that more cars get totaled? And so that's kind of the offset there. As I mentioned, what's been happening is that even if there are fewer accidents now, the accidents that do happen are much more likely to result in the car getting totaled. And that is because the repair cost has gone up so much. And so when you have all these sensors, all this tech in the car, and you continue to add more, it just gets more and more expensive to repair these cars. And so that is kind of the existential risk is AV. As for now, though, technology in cars has actually been good for Copart. I suppose the other sort of risk is that somehow repair costs go down. That could happen for reasons that maybe aren't entirely clear to see. As of now, there are, definitely fewer mechanics, people entering that field than in the past. And so that's made labor more expensive. But if there was some way to autonomize repairs, or maybe there's a way to kind of swap in and out parts, some sort of modular car, that could be a negative. Or there is a little bit of a push for manufacturers like Tesla to try to take more control over their cars and the repairs. For instance, once Tesla is totaled, they will turn off the supercharging feature. And so maybe they do more stuff like that where they just lock the car. However, offsetting that is also, the right to repair. There was a case recently about that with Apple. And so all of that is pretty speculative now.
Yeah. Can we get more into the financials a bit? What impressed you or surprised you about sort of how they think about their cash, their sort of balance sheet or expenses, or where they allocate capital?
Yeah. So in terms of like the return on invested capital, it's 25%, which is very good, and it's been that rate for decades, and even in recent years has actually increased. And so that on its own is pretty impressive. It's a little confusing when you look at them, because they have these sort of two revenue recognition lines. One of them is going to be service revenues, and the other one is going to be sales. And so that delineation comes back to whether or not it's 1P versus 3P accounting. So basically whether or not they're the merchant of record. So as I mentioned, especially in newer markets, they will buy the car and take ownership of it and then later resell it. If that's the case, there's going to be a cost of goods sold line item. And so that in short, it distorts revenue. And so if you didn't understand that, don't worry about that. We adjust for that. Net revenues are about 3.4 billion. They're up low double digits. EBIT is about 1.6 billion, and net income 1.4 billion. With free cash flow of about 800 million. However, and this is, I think, what maybe some people overlook, is that within that free cash flow is a lot of growth capex. Whenever you're looking at free cash flow of a company, you have to delineate between maintenance capex and growth capex, because what you basically want to get to is, if I'm not touching this business, how much money is it going to continue to generate? And the way you do that is by you back out the growth capex. And so of the 800 million in free cash flow, that is after $500 million in capex versus depreciation of about 150 million. Now, depreciation is not always a good barometer of what maintenance capex is in a business. However, when you're looking at a company like Copart, where it's literally junkyards. Like, you don't have to make these look very nice. There's not a lot of upkeep involved in it. They don't own that many vehicles. They own some, especially associated with the cat event stuff. But by and large, there's not a lot of maintenance capex necessary to continue to run this business. And so if you adjust that out, we would estimate owner's earnings, which is kind of how much cash as an owner you can expect to come back to over time, to be roughly in line with net income. And so that is just a few numbers there. And so if you're looking at them over time, though, they've kept up this growth for a very long amount of time. About, just since 2015, net revenue growth has been at 20% CAGR, and they do use shares sometimes when they're acquiring lots, and so you do have to adjust that out for a fair comparison. But you're still looking at like a mid-teens revenue growth CAGR over a very long time, which very few companies have ever achieved.
That's a good overview. Maybe summarizing some of the points here, why don't you present both the bull case and the bear case as you've described it out today when you think about the business and its potential going forward?
Yeah, so just on the business, which is separate from the valuation and what the market might imply is necessary today in order for an investor to get an adequate return. So just in terms of the business, it's just extremely hard to disrupt them. I mentioned some of these factors. You basically would need to replicate their land footprint, land that they held on their balance sheet since the 80s, land that is no longer available, land that will never be licensed again for salvage vehicle operations because they leak dangerous chemicals and no one wants that near them. On top of that, you also have to get the integrations directly in with the insurance company. You have to have the data to be able to inform the insurance company the value of the salvage car. And then on top of that, you need to overlay an entire marketplace, which should be a global marketplace, in order for you to get the highest price per vehicle. And in addition to all this, you need to keep a very high service level. And so all of these factors, it's just very hard to disrupt them. Everything in terms of repair costs going up has meant that not only are there going to be more totals, but also the cars that are totaled tend to be of higher quality because of all of the tech increasing in the car. And so basically, they've been winning on both volumes and pricing for some time, and it's not entirely clear why that would end anytime soon. You could say to the negatives, over the long term, autonomous vehicles could prevent accidents, so you could see volumes drop. Over the super long term, if you do get autonomous vehicles, then that would be an issue for the business as accidents no longer occur. You could have OEMs trying to take control over their repairs. On top of that, you could have more CAT events, where CAT events are usually not profitable for them, but are cost. And so the more of them that they have, it could eventually weigh on earnings. And other than that, potentially you just have some sort of operational issues, but not exactly clear what that would be, as they tended to be run pretty well.
The zooming out a bit, I know obviously the report is very thorough, and you had your own 2-hour podcast on this. What have we not spoken about as it relates to the business that you think is pretty important to either understanding the business itself or just some of the more broader lessons that can be applied otherwise?
Yeah, I think just kind of zooming out a little bit, if you want to think of sort of like the revenue build for this company, it is ultimately going to be three things. It's going to be number of salvage vehicles, it's going to be their revenue per unit, and it's going to be their market share. And so we talked a little bit about what goes into the salvage vehicle equation, but there's all of these kind of offsets. So let's say that repair cost increases. Okay, then that means that they're more likely to total a car, or whether or not they're less likely to total a car. There could also be an impact from car prices increasing. The more car prices increases, it might mean that the more people are willing to bid at auction for these cars. And so if they're bidding more at auction, then the auction price increases, but then it could also bleed into the average cash value of the car, which is the pre-damage value of the car, also increasing. And so there's all sorts of these honestly confusing offsets to the equation of whether or not a car gets salvaged or not. On the earnings calls themselves, CEO Jay Adair and would kind of talk about, he himself is not so clear exactly whether or not they benefit from there being more volume or more ASPs, but either way, as I mentioned, the trend has been that there's more salvage vehicles as there's more tech in these cars, more getting totaled, and the cost of repair is increasing. Then the other factor is the revenue per unit. We didn't touch into it much, but right now, the majority of the revenues they generate are on the buyer side. They don't actually charge the insurers that much. And that is just because there's not that many insurers, and getting the supply in order to sell it in the first place is where the leverage lies. And so buyers, face take rates anywhere from 20 to 25%, whereas on the insurance company side, I've seen as low as them paying 1%. And so it's very little the insurance companies pay. And so you could question to what extent can they continue to extract value from the buyer side, except at the same time, they don't have any sort of leverage on the buyer side. And that's kind of held evident by a company called LKQ, which did try to go direct to the insurance companies, and that ultimately didn't work out. And then the last aspect of this is just market share. Copart's steadily been gaining market share over time, but whether or not that's going to continue, it doesn't seem so likely in North America because, again, these insurance companies do want to have this offset in IAA. It's more likely internationally. And so that's just kind of a high-level overview there. And in terms of anything else with Copart, I guess maybe just touching on the potential for this sort of non-salvage volume in order to be a more material part of their business. That could be something significant in the future. And then the other growth factor is really just international. But in terms of like the moat and the company and how well it's run, I am very much not the first person to note this. And I think to an extent, a lot of that has been reflected in the assumptions you would need to make today in order to get a return on the stock if you're doing sort of the reverse DCF.
And you haven't commented yet on the price itself at the moment. You were just talking about the business a few minutes ago, right? Is there any commentary you can give on your thoughts on that?
So the way I usually answer this question is we like to reverse what the assumptions are implied in the current market price. And so if you look at Copart today, it's a 50-some billion market cap company, and you could call owners' earnings to be around like 1.4 billion, something like that. And so then you could ask the question, why would you want to pay that multiple? And the way we answer that question is by inverting the question. So let's assume that you do pay that. What would you need to assume happens in order to get a different table of returns? And so you would need a certain amount of volume, and you would need a certain amount of ASP, average selling price per car. And so we detail out in the report what that sensitivity looks like. And that's one way you could do it. Another way you could do it is you could assume that they continue to reinvest different amounts of capital and are able to continue to get their historical 25% return on invested capital. And then how many years that needs to go on, and what the invested rate of return, what the return on invested capital would be if you want to sensitize around that 25% number. That's another way you could kind of answer that question.
Yeah. I think this might be a good place to wrap. We're at the hour. Drew, this has been a great overview of Copart, as well as an introduction to how you guys think about reports. I highly recommend people subscribing to your podcast, as well as your very deeply researched reports. I haven't seen anyone do deeper reports on companies. Drew, thanks so much for coming to the podcast.
Yeah, Erik, thank you for having me.
Thanks for listening to Company Breakdowns. Make sure you're subscribed on Spotify, Apple, or YouTube. Let us know in the comments or reviews what companies you want us to deep dive on next. Company Breakdowns is a show from Turpentine, the network behind Moment of Zen, Turpentine VC, Turpentine Finance, and Request for Startups.